temporarily. It's a great pleasure to be here, and the topic of my speech this morning is shifting sands in the international bond markets. I'm Bryan Pascoe, the Chief Executive of the International Capital Market Association, ICMA, and it is indeed a great honor to have been invited not only to join such an auspicious gathering of international industry leaders here at WFC2025, but also to have been given this opportunity to address the conference. And for that, I'm especially grateful to Yedel and the entire KCSD team, and also for their extremely generous hospitality, which I think we've all enjoyed so far. Many of you will be familiar with ICMA and the work that we do, and indeed a good number of you are ICMA members. However, if you allow me, I would like to say a few words about our organization, and hopefully that will be relevant to all of you. ICMA has a long history of engagement in the world's capital markets, supporting their development by fostering efficiency, resilience, and well-functioning bond and repo markets. Our work is grounded in setting global best practice, engaging with regulators, and promoting transparency. We serve as an essential bridge, I would say, between the public and the private sectors, helping to ensure that market standards evolve in a way that benefits all participants. And our initiatives, such as the Primary Market Handbook, the Global Master Repurchase Agreement, and the Green and Social Bond Principles, are widely recognized as benchmarks in their respective fields and reflect our commitment to advancing the integrity and effectiveness of capital markets. ICMA was established over 50 years ago. We're headquartered in Zurich with offices in London, Paris, Brussels, and Hong Kong, and have over 630 members in 71 jurisdictions worldwide, which represents global players across the entire spectrum of the fixed income industry and activity. This ranges from debt issuers, underwriters, traders and brokers, investors of all kinds, to market infrastructure providers also of all kinds, credit rating agencies, law firms, and other official institutions such as central banks, and tech solution providers and vendors now. We're increasingly becoming a part of our tapestry. So in that sense, we truly are the voice of the international debt market. Among the number of members, I'm very pleased to say that we now have over 70 CSDs and financial market infrastructure members globally, with representation across Europe, Asia, the Middle East, and Africa. And this is growing quite substantially. And this is highly reflective, I would say, of the increasingly pivotal role that FMIs are playing internationally as catalysts to galvanize markets, boost efficiency and transparency, underpin data initiatives, and drive transformation and digitalization, propelled by both industry and regulatory forces. Within ICMA, our growing FMI member base is increasingly visible in setting the agenda across all of our work streams, and we're delighted that we can provide a platform through our committees and forums to convene all market participants and coordinate important initiatives for best outcomes in the fixed income markets. So, with this in context, I would like to spend the next 10 minutes or so to reflect on some of the major current and future themes we are seeing influencing and shaping bond markets as the sands shift, so to speak. These are namely changing market structure, electronification and democratization, initiatives in market efficiency, and the rise of transformational technologies. And indeed how ICMA and FMIs, CSDs in particular, are embedded in all of these areas and key to their evolution. So firstly, changes in market structure. Global bond markets across international and domestic markets and developed and emerging jurisdictions currently total an eye-watering of around $140 trillion equivalent in size, by far the largest financial and most pervasive asset class. But this is obviously not static, and in fact it's just the beginning of the story. With market growth and structural change taking place at a rapid pace against the backdrop of unique strains in global political and economic relations, rising fragmentation evident in many areas, and leverage increasingly underpinning market activity, we're unquestionably at a critical juncture. The topic of evolving bond market structure and the dynamics underlying it is something that we are highly focused on at ICMA. New market entrants and trading protocols are increasingly driving market activity, and what was once a very bank-led market has seen NBFIs come to dominate flows in many asset classes. This throws up new and consistent challenges to how markets adapt and remain resilient, and also how the regulatory community responds to underpin this. This new dimension of liquidity led by non-bank players, and particularly hedge funds, is extremely important given the growth in markets already mentioned, and banks no longer having the capacity to intermediate risk consistently, especially in times of stress. So, while it is critical that the right regulatory guardrails are applied to maintain and bolster financial stability, and for visibility on their activities to be improved and better coordinated, the liquidity and demand provided by these new players and hedge funds needs to be nurtured. Data shows that the footprint of hedge funds in the core sovereign bond markets, principally in Europe but also beyond, has increased markedly, and in some cases accounts for more than 50% of secondary market volumes. In some cases, we have also seen these entities take on the role of liquidity providers and market intermediaries. As we look ahead, system-wide approaches to assessing risk will become core to the regulatory toolkit, and within this, the data, risk management and efficiency creating capabilities of market infrastructure players will become even more critical to support and promote market integrity and efficient functioning, underpinning stability by ensuring the smooth and orderly repricing and transfer of risk as needs arise. The confidence and transparency of orderly settlement, timely collateral transformation, and liquidity management provided by FMIs, even in times of heightened volatility or crisis, will become ever more critical to provide the robust foundations for market resilience. Moving now to electronification and democratization. The emergence of the ETF product as a prominent asset class, particularly in the case of investment-grade credit, has increased activity in the underlying bonds, also allowing non-banks to take on a critical role as approved participants, again forming a key source of bond market liquidity. While still relatively small in terms of total market activity and not yet material across many emerging markets, fixed income ETFs globally are already in excess of $2 trillion in size across over 1,200 funds, with exponential growth in this space expected. Importantly, while bond markets are still heavily dominated by institutional players, ETFs also facilitate much greater direct retail involvement into the fixed income space, broadening the investor base and providing attractive investment alternatives. This undoubtedly will continue. Underpinning this trend have been two key interlinked dynamics: the increasing availability of data and advances in automation. This has enabled low-touch systematic trading across a range of fixed income asset classes, as well as powering new trading protocols, as mentioned earlier, such as portfolio trading. We can only expect this direction of travel to continue, increasingly blurring the distinction between the role of sell and buy sides. And while this is still largely a developed market phenomenon, the forces of data and automation will play a central role in the development of emerging and frontier markets. These evolutions shift market infrastructure demands and create new service areas for CSDs, especially in more electronic and real-time settlement, as well as advanced settlement netting tools and auto-collateralization and optimization. There is also the scope for CSDs to develop further as prime sources of high-quality data and analytics, which is the lifeblood of algorithmic trading. This clearly aligns already with the evolving business models of CSDs and FMIs more broadly, undertaking increasingly multifaceted and customer-centric service propositions. I move now to market efficiency drivers. As we have seen in recent reports from the FSB, the European Stability Board, and the Bank of England, among others, the ability of markets to function in times of acute stress is firmly on the radar of regulators and policymakers, and very much at the top of the agenda for our engagement at ICMA with the official sector. We see this in the push for shorter settlement periods and the use of central clearing for core government bond markets, including repo. The global move to T+1 settlement, which we've discussed a lot in the course of the last day and a half, which is now underway or completed in many jurisdictions, major jurisdictions, and in the case of the US, mandatory clearing for treasuries. These are both responses to the concerns that exist at the regulatory level and are seen as essential levers to boost efficiency and reduce risk in the system. These initiatives are not straightforward and are immensely complex and resource intensive. At ICMA, we are heavily involved in ensuring their successful implementation while also identifying the associated practicalities, challenges and risks, as well as the benefits. We remain deeply engaged with members on pinpointing and assessing these factors, notably with CSDs and other market infrastructures, who sit at the center of many, if not most, of the critical process and system changes that will be needed to ensure that these new developments do not lead to market instability, as well as with the regulatory authorities across a broad range of jurisdictions. As part of this, incorporating more formalized settlement efficiency initiatives, such as shaping, partialing, and auto-borrowing and lending, sitting within the FMI architecture, are key facilitators of greater resilience, and broad-based adoption of these tools is something ICMA advocates for very strongly. Finally, I'll turn to the rise of transformational technologies. Perhaps one of the most exciting and unavoidable themes in global bond markets these days, we've heard again about this theme on multiple occasions in the course of the last day and a half, is the huge potential offered by digitalization. This is a core focus and commitment of ICMA, and I'm sure for many, if not all of you in the room, spanning applications of distributed ledger technology, tokenization, wholesale central bank digital currency, and increasingly AI. As a leading market voice of the debt markets, we're playing a vital role in supporting the market transition from analog to digital. Again, we are working with our global network of members as well as with the regulatory and policy community to identify the challenges, formulate solutions, and help deliver the benefits this should bring. Fintech and digitalization is one of ICMA's core cross-cutting themes, with a dedicated team of specialists engaging across all of our core pillars, primary, secondary, and repo and collateral markets, as well as sustainable finance, and looking at the impacts of cutting-edge technology and innovation on all aspects of the bond lifecycle, from issuance through trading and post-trade. Where we see ICMA playing a critical role is through driving standardization, which is essential for realizing the potential opportunities and efficiency gains that digitalization brings. In this regard, I'd like to flag two key initiatives where ICMA is leading the way in setting standards for digital innovation with our partners. Firstly, the bond data taxonomy. The BDT, as we call it, published first in March 2023, provides an agreed language to promote automation and reduce the risk of fragmentation across bond issuance, trading, settlement, and distribution. The BDT provides a standardized and machine-readable language of key economic terms of a bond, such as amounts, currency, maturity, interest, key dates, such as pricing, settlement, coupons, etc., as well as other relevant information, governing law, relevant parties, ratings, selling restrictions, etc., all typically included within a term sheet. Where relevant, the BDT incorporates existing ISO data definitions and formats also. Designed with active input and guidance from our broad membership, it is technology agnostic and is designed to be used both for traditional debt securities as well as DLT-based debt securities. We've already seen the adoption of the BDT, such as the HKMA, the Hong Kong government's benchmark digital green bond issuance in 2024, issued through Hong Kong CMU OmniClear, the Monetary Authority of Singapore's Project Guardian on asset tokenization in the fixed income, asset management, and FX space, as well as also the incorporation of the BDT into a number of private debt issuance platforms. It's also very encouraging that the ICSDs, working together, are incorporating the BDT into their systems and processes to help drive standardization. And this is a major catalyst for broad, cross-jurisdictional based industry adoption. Secondly, and complementary to the BDT, is the Common Domain Model. The Common Domain Model, or CDM, this is a standardized machine-readable and machine-executable data and process model for how financial products are traded and managed across the transaction lifecycle. The CDM is based on cross-industry collaboration between ICMA and our other sister trade associations, ISDA and ISLA, and facilitates trade processing of repo, securities lending, and straight-through and derivatives transactions. It's designed to improve interoperability and straight-through processing, to deliver better regulatory oversight, including reporting, and to create an environment for innovation in financial markets. Together, we believe that the BDT and the CDM are helping to set the framework and guardrails for tomorrow's financial markets. We remain highly focused on unlocking their potential across all jurisdictions, and in particular emerging markets, where often the relative lack of complex legacy infrastructure can make implementation smoother, quicker, and more efficient. And this is where infrastructure, not least CSDs, have an important role to play, and where so many opportunities present themselves. In supporting the development and the implementation of standards globally, they ensure interoperability and ease of market access, benefiting developed and emerging markets alike, which is ultimately to the benefit of the global economy. To wrap up, changes in the international capital markets ecosystem are happening now at an unprecedented rate, and there's a huge amount for us to contend with right now. I've covered a few of the most pressing developments in this address, from evolving market infrastructure, the exponential growth in the availability of data, even greater automation, the ongoing headwinds facing economic growth and geopolitical stability, concerns about market resilience, and the drive towards innovation, new technologies, and the digital paradigm. For all of us, this provides new and evolving challenges, but also significant opportunities to embrace the now and build for the future. The entire industry must come together to ensure all elements of change can help to drive the bond markets forward to meet the challenges of this growing and increasingly complex market. CSDs and FMIs sit at the center of this, and ICMA stands ready and eager to play a positive and prominent role in fostering cross-industry engagement and working with all of our stakeholders to ensure that optimal outcomes are achieved. Thank you very much for your time.
Mr. Bryan Pascoe, thank you for your speech. Dear participants, we're now announcing a short break of 30 minutes.